now we're going to move to the cash flow statement. We have just done our forecast of the income statements, right? So now we're going to be thinking about cash flow. As we learned in Module 1, right, the cash flow statement has 3 different parts: the cash flow from operations, cash flows from investment, and cash flows from financing, right? And then at the end, we have the net change in cash. We already talked about that. So cash flow from operations, cash flow from investing, financing, and then the net change in cash at the end, right? Which is what we learned in Module 1. So here again, we have the 2014 cash flow statement for PepsiCo, right? So those are the actual numbers that PepsiCo reported in 2014. So you start with the earnings, right? And then you make the adjustments to change earnings into cash flows, right? Depreciation, you're adding depreciation because it's a non-cash expense. The company actually had some positive cash flow from working capital in that period, so that's how you end up with a 10.5 billion cash flow from a 6.5 billion net income number, okay? But our goal here is to forecast the future, right? So what we're going to do is, again, keep using the assumptions that we made in the percentage of sales model, right? So we have the depreciation in 2015, for example. We are going to use the percentage of sales model, right, and assume that depreciation is going to be growing at the same rate as revenues. Okay, so depreciation is going to be a constant fraction of revenues. That's why we have the 4.4% growth rate here. Okay, so in terms of working capital, our assumption is that working capital is going to be 2% of revenues. Okay. And you might have learned this already or not. In any case, we are going to be talking about this in this module when we talk about working capital. We should think of working capital as an investment. Okay? Working capital is an investment in the business, right? This investment is going to generate a negative cash flow. Okay? So it's exactly like a capital expenditure. So there is an investment in net working capital that PepsiCo requires that is equal to 2% of revenues. Okay, so as we did in the other, in the case of the income statement, okay, we can go back here and start writing down our numbers or doing it in a spreadsheet, right? So we have the earnings here, right, that you start with, right, and then we have the depreciation that we just figured out. Okay, it's like $2.2 billion, right? The investment in net working capital, right? With the other adjustments, as we just discussed, we are going to keep the assumption that these are one-time items. We're not going to worry about those, so we're going to set those to 0, right? And then, given that, we can compute the cash flow from operations for PepsiCo in that year, which should be equal to $7.3 billion, right? So you're adding depreciation, deducting the investment in net working capital, you're going to come up with a cash flow from operations of $7.3 billion. Right? And then we move on to the part of the income statement where we have our capital expenditures. Remember, our original goal was to figure out whether the company could fund this expansion plan, this capital expenditure with internal funds, right? So that's where the capital expenditures are going to be entered in the financial statement, right? So here we assumed that there is going to be a 3.5 billion capital expenditure in 2015 and a 6.5 billion capital expenditure in 2016, right? So we enter those here, which means that your cash flow from investing in the future years are going to be equal to those numbers, right? So PepsiCo is going to require 3.5 billion to invest in 2015 and then 6.5 billion to invest in 2016. Right? So now we have the cash flow from operations, we have the cash flow from investment, right? Let's think about the financing cash flows, okay? So one of the assumptions we used is that dividends are a constant fraction of earnings, right? So dividends are going to be a constant fraction of earnings, so you can forecast dividends using that formula, right? The same ratio that PepsiCo paid in 2014 is going to be paid off in 2015. Okay, and now I want you to think about this question. Okay, this is an important part of the financial state of our forecasting exercise, is to figure out which value should we input for net debt and net equity issuance. Okay, so which values are we going to put in the cash flow statement for the items that correspond to debt and equity issuance, right? And just a hint for you, that has to do with the question we asked to begin with. So remember, right, the question we are asking is, can PepsiCo finance this expansion without new debt or equity issuance? Right, that's the question, right? So if we have no new issuance, right, really what this means is that it's a big zero, okay? That's what we should have, right? There is no new funds coming into the company. What we're going to do is we're going to input some big zeros in that cash flow statement, right? So here we go back to the cash flow statement, right? And every time you see net issuance of stock, net borrowing, we're going to add zeros. Okay? So this is not, and this is not an assumption. It really is the question you want to answer, right? You want to figure out if PepsiCo can finance the expansion plan without issuing new funds, so you have to input zeros here, right? If you had some funds coming in, then you're not asking the right question if you want, right? So that's what this is the answer. That's what we should do. So I think now we are ready to look at the entire cash flow statement, right? So that's our answer. The numbers we plugged in, right? Here's the capital expenditure, right? And the dividends, right? Notice that the dividend is coming in with a negative sign, right? Because dividend is a use of cash, is going out of the company, right? And then we have the zeros, right? There's no new issuance of stock, no new borrowing, okay? There are no negative numbers either, right? Notice that in 2014, PepsiCo was actually repurchasing stock, okay? So what we're going to do is we're going to eliminate this repurchase program going forward and ask whether PepsiCo has sufficient cash to pay for these investments, right? So with all these assumptions, we can figure out the total cash flow from financing, right? Which in this case is just going to be the dividend. So essentially, we are assuming that PepsiCo is only paying out the dividend and is not issuing issuing new stock or debt or making any stock repurchase or paying debt, right? So we come up with the cash from financing here, and then in the bottom we can estimate the net change in cash, right? So that's the amount of cash that PepsiCo is going to be generating in 2016 and in 2015 according to our financial model, right? So just to put the words here, if our model is correct, PepsiCo is going to be generating $190 million of cash in 2015, and then it's going to be generating minus $2.6 billion of cash in 2016. Okay, so that's what we come up with, right? So now let's try to answer the question. We have the income statement, we have the cash flow statement, and we've just figured out that the company is going to have a net change in cash of $2.6 billion in 2016. So, there is a negative number, right? So the question is, does this negative number require PepsiCo to issue new debt, for example, right? So does PepsiCo need to raise money from investors to cover this negative change in cash or not, right? So that's what we're going to do next. And as you're going to learn in a second, we actually now have to go to the balance sheet, right? And we have to think about how much cash the company has in order to answer this question.